All right, you know that feeling, right? When you're faced with just a massive decision. One that could, well, change everything.
Oh, yeah, definitely.
Maybe you're mapping out your career path or, thinking about a really significant personal investment, like that dream home maybe.
Or even just starting a side hustle, something like that.
Exactly. And it's not just like a gut feeling decision. It feels more like a swirling vortex of numbers, potential risks, future unknowns.
Yeah.
It can get overwhelming.
Absolutely. And for big companies, these aren't just big decisions. They are monumental. We're talking choices that lock in millions, maybe billions for years down the line.
So today, that's what we're diving into, right into that vortex. We want to cut through all that complexity, all the noise, and really pull out the clearest, most useful insights into how these companies, and honestly, by extension, how you can make truly smart, long-term investment choices.
Yeah, get ready for some genuine aha moments, hopefully.
I think so.
What's really fascinating here, I think, is that we're essentially peeling back the curtain on something called capital budgeting and the financial decision models that, really drive it.
Right, capital budgeting. It
Uh,
sounds kind of intimidating.
it can. It often feels like this sort of secret language, doesn't it? Full of acronyms, formulas. It's easy to get lost. But our mission for this deep dive is actually pretty straightforward.
Okay.
We want to give you a crystal clear roadmap through these, frankly, powerful tools. So by the time we wrap up, you'll not only get how businesses rigorously evaluate these huge projects,
Mm-hmm.
but you'll also have the key insights, the core ideas to confidently look at financial reports, maybe even approach your own long-term decisions a bit more strategically.
That sounds incredibly useful.
We've tried to synthesize a really comprehensive body of knowledge on these financial decision-making principles. The goal is simple. You walk away feeling genuinely well-informed, ready to spot those aha moments yourself.
Okay, so let's start right at the beginning then.
Hmm.
The absolute bedrock. What exactly is capital budgeting?
Right. So in its essence, capital budgeting is the critical process companies use. It's for evaluating and then selecting long-term investment projects.
Long-term being the key phrase there.
Absolutely. Think of it like a blueprint for the company's future. We're talking about decisions that commit a company's precious cash resources over really extended periods.
Like what kind of projects? Give us some examples.
Sure. Think about building a brand new state-of-the-art factory or launching an entirely new product line that might take, I don't know, years just to develop.
Okay, big stuff.
Huge stuff. Or maybe investing in a massive fleet of electric vehicles to completely transform their logistics. These aren't, your small day-to-day operational expenses.
Right, not like buying paper clips.
Exactly. These are strategic foundational moves. They dictate where a company is going to be 5, 10, maybe even 20 years down the line. It's absolutely crucial, really, to an organization's long-term success.
Because it determines how they invest capital to generate future returns.
Precisely. It's like, planning a major life purchase, like buying a house, as you said earlier. But imagine doing that for a massive multinational corporation.
Where the numbers have a lot more zeros.
A lot more zeros, millions, sometimes billions. And the ripple effects on the company's entire path forward are just, well, enormous.
Okay, so if capital budgeting is the process, what's the key element we need to understand first?
Cash flows. Absolutely. 100% cash flows. When we scrutinize these big investments, we have to talk about cash flows first. And it's not just about, money changing hands in a simple way.
Okay, how so?
Well, cash flows, especially in capital budgeting, they kind of have two distinct faces. There are the direct effects and then the indirect effects.
All right, let's start with direct. Those sound easier.
They usually are.
Yeah.
Direct effects are the immediate, tangible cash payments or receipts, the ones directly and, frankly, obviously tied to the investment.
Like buying the machine.
Exactly. When Carlin Company, for example, actually pays money out of its bank account to buy a new machine, that's a direct cash outflow. Simple.
And if they sell something made by the machine.
Right. If they sell a product made by that machine and receive cash from a customer, that's a direct cash inflow. They're pretty simple, observable, clearly tied to the project. No real mystery there.
Got it. So what about the indirect effects then? Those sound more complex.
They can be a bit more nuanced, yeah. These are transactions that aren't immediately obvious as cash movements, or sometimes they're non-cash activities that nonetheless produce real cash benefits or obligations down the line.
Okay, like what?
The biggest one, the most potent example, and honestly one that often trips people up is depreciation.
Depreciation, the accounting concept.
Exactly. Now, depreciation itself, as you know, it's a non-cash expense. You're not literally writing a check labeled depreciation each month.
Right. It's an allocation of the asset's cost over time.
Precisely. It's an accounting allocation. But here's where that aha moment comes in, relating it back to cash. Because depreciation reduces your taxable income on paper. It effectively reduces the amount of tax you actually owe, the cash you pay to the government.
Okay. So the reduction in the tax bill.
That reduction. Those saved taxes, because you took that depreciation expense, that's a very real, very tangible cash inflow. It's often called a tax shield.
Right, the tax shield. So that raises the question you mentioned.
Right.
Why do we care so much about a non-cash expense like depreciation in a cash flow analysis?
Exactly. Because that tax saving, that reduction in the actual cash going out the door for taxes, is a direct cash benefit. You wouldn't have it without the depreciation
It
deduction.
makes perfect sense when you put it that way.
So the net effect, then, is simply the total picture. You add up all the direct payments and receipts, and you combine them with these indirect cash benefits or obligations, like the tax shield. That gives you the complete unvarnished picture of how a project truly impacts the company's actual cash.
It's actually incredible how those indirect effects, especially that tax shield, can really shift the whole financial picture of a project.
Absolutely profound impact sometimes.
And these cash flows, they don't just happen all at once, right? Not just one moment.
Yeah.
They unfold over the project's whole life.
Correct. We can usually break this down pretty neatly into 3 general stages. Each stage has its own unique set of cash flow things to think about.
Okay, what's stage 1?
Stage 1 is what we call the inception of the project. Often you'll see it marked as time period 0 on timelines.
The very beginning.
The very beginning. This is the moment the initial investment happens, and yeah, it typically represents the single largest chunk of cash outflow a project will ever require.
And then this is mostly those direct outflows we talked about.
Primarily, yes. Things like the core acquisition cost of the asset itself, the hefty purchase price for that brand new machine, that's usually the biggest piece.
But you said there are indirect effects too, even at the start.
Exactly. And they can be critical, even at inception. A really significant one is working capital requirements.
Working capital. Remind us what that is again.
Sure. Simply put, it's the difference between your current assets like inventory, receivables, and your current liabilities like accounts payable.
Okay. So how does that relate to a new project?
Well, when a company kicks off a new capital project, it often needs to tie up additional working capital just to support that project's immediate operations.
Like needing more raw materials on hand.
Exactly. You might need to increase your raw material inventory to support the new production, or maybe just hold more cash readily available for initial operational needs specifically tied to this new project.
So that's an outflow.
It's treated as an indirect cash outflow right at the project's start. Why? Because those funds are now committed, they're tied up in the project, and crucially, they're unavailable for other things the company might want to do.
Opportunity cost again.
Precisely. But there's a silver lining. When the project eventually finishes,
Yeah.
any unused or released working capital funds, that cash becomes available again. So that's treated as an indirect cash inflow right at the very end of the project's life.
Okay, that makes sense. Get it back later. What else happens at inception?
Another crucial indirect effect, potentially, relates to disposing of any old asset that the new project might be replacing.
Oh, replacing old equipment.
Exactly. And here's where it gets really interesting, because how you handle that old asset can directly impact the net initial investment cost of the new one.
How so?
Well, say you just decide to abandon the old asset. Just scrap it. If it still has some remaining book value on the company's books, hasn't been fully depreciated yet, that remaining book value can often be treated as a deductible tax loss.
Which means?
Which means it decreases your tax liability. And that tax saving effectively acts as a reduction of the new asset's initial investment cost. It lowers the net hit.
Interesting. Okay, what if you sell the old one instead?
If you sell the old asset, the cash you receive obviously reduces the new investment directly. That's straightforward.
But there's a tax catch, I bet.
There often is. You have to consider the tax implications of that sale. If you sell the old asset for more than its book value, you realize a gain.
Right.
And the income tax you pay on that gain effectively increases your initial expenditure on the new asset. It adds to the cost.
And if you sell it at a loss?
Conversely, if you sell the old asset at a loss compared to its book value, The resulting tax reduction from that loss actually decreases your net investment in the new project.
Wow. So these seemingly small details, how you handle getting rid of the old stuff, can actually have a pretty substantial impact on figuring out the true net initial investment for the new project.
Absolutely. It's not just the sticker price plus shipping. You've got to factor all this in for an accurate picture.
That definitely brings a whole new layer of complexity.
Yeah.
It makes the initial investment calculation seem much more involved than just adding up a few obvious costs.
It really can be. You need to be thorough.
Okay, so after we navigate that initial outlay, all the direct and indirect effects at time zero, we move into stage 2, operations.
Right. The heart of the project's life. This is where you see the ongoing cash flows being generated, hopefully on a regular basis, from the project's day-to-day activities.
And these can be steady or variable.
Exactly. Sometimes they might be quite uniform, almost like an annuity payment coming in year after year. Think of maybe stable rental income from a property investment.
Okay.
Or they can vary significantly, maybe based on fluctuating market conditions or changing production levels or other factors specific to that project.
And that depreciation tax shield we talked about, does that keep going?
Oh, yes. Throughout this entire operational stage, those depreciation tax shields continue to play that vital role. They consistently generate those indirect cash flow benefits year after year just by reducing the company's tax burden.
So it's like this quiet, hidden benefit that keeps boosting the project's financial performance.
It really is. It's that gift that keeps on giving, financially speaking, silently boosting the project's viability over its operating life.
All right. So after years of operation, we eventually get to stage 3, disposal of the project.
The end of the line. This is when the investment's useful life runs out, or maybe its economic viability just isn't there anymore. And there are specific, often quite significant, cash flows that happen right at this final point.
Okay, what kind of flows? Similar to Inception.
Some similarities, yes. You'll definitely have direct effects, like the straightforward cash inflow you might get from selling the asset for whatever its salvage value is at the end.
Makes sense. Sell the old machine for scrap.
Right. But once again, we absolutely have to account for the indirect effects. This could mean taxes due if you sell the asset for a gain, just like selling the replaced asset at inception.
Or taxes saved if you sell it for a loss.
Or taxes saved if you sell it for a loss, exactly. Plus, there might be direct cash outflows specifically tied to the disposal itself.
Like what?
Maybe specialized dismantling costs, or even things like severance pay for employees whose jobs were directly tied only to that specific project and aren't needed anymore once it shuts down.
Ah, okay. Hadn't thought of that.
And there's more. What if you just scrap the asset? Or maybe donate it and it hasn't been fully depreciated yet? So its net tax basis is still above zero on the books.
Yeah.
Well, that remaining basis can often be taken as a deductible tax loss, resulting in tax savings, another potential indirect cash inflow at the end.
Okay. Lots of potential tax implications at disposal.
Definitely. And remember that working capital commitment we talked about way back at inception?
Yeah, the money tied up initially.
At disposal, as the project winds down, that commitment is typically released. Inventory gets sold off, receivables collected, etc. So that creates an indirect cash inflow as those funds finally become available again for other corporate uses.
So putting it all together, what does this all really mean?
It means that every single stage of a project, from its very first moments at inception, through its working life and operations, right to its final disposal, each has its own unique, often intricate cash flow story. And that story involves both the obvious direct impacts and these often critical indirect impacts on the company's actual cash position.
And getting those nuances right is vital for doing the analysis properly.
Absolutely vital. You miss those indirect effects, especially the tax ones, and your whole capital budgeting analysis could be significantly off base.
Okay, that's a really clear breakdown of the life cycle. Now let's put some actual numbers to this. How do we calculate these cash flows, especially distinguishing between pre-tax and after-tax?
Good question. So pre-tax cash flows are, well, pretty straightforward. They basically represent an asset's value based on the present value of the future cash flows it generates before you even think about taxes.
And they give you a quick first look.
Yeah, it's an early signal. If a project shows significantly larger cash outflows than inflows even before taxes are considered, that's a pretty strong red flag right away that it might be unprofitable.
Makes sense. But for the real decision,
For any serious capital budgeting decision, it's the after-tax cash flows that are truly crucial, absolutely critical.
why the emphasis on after-tax?
Because taxes are real. They are a very substantial cash outflow for any profitable business. And they significantly impact the amount of cash that's truly available to the company. Cash they can actually use for reinvestment or maybe distribute to shareholders.
And it's different from just looking at net income on the accounting statements, right?
Critically different. After-tax cash flow differs from accounting net income because, as we discussed, those non-cash expenses like depreciation must be added back to net income to arrive at the actual true cash flow figure.
Okay, can we walk through an example, make it really concrete?
Definitely. Let's imagine a simple project. Say it generates annual cash inflows of $40,000. It has $10,000 in depreciation expense each year, and the company's tax rate is 40%.
Okay, $40 K inflow, $10 K depreciation, 40% tax.
Right. Now, we can calculate the after-tax cash flow using two different methods. And importantly, both methods should lead us to the exact same correct answer. That's a good way to check your work.
All right, method one.
Method one is what you might call the income statement approach. You basically follow the structure of an income statement. First, calculate pre-tax income.
So inflows minus expenses.
Right. Cash inflows are $40,000. We subtract the $10,000 depreciation expense. So $40,000 minus $10,000 gives us a pre-tax income of $30,000.
Okay.
Now, apply the 40% tax rate to this $30,000 pre-tax income. $30,000 times 40% equals $12,000 in taxes.
Got it.
Subtract those taxes from the pre-tax income to get your net income. $30,000 minus $12,000 leaves $18,000 in net income.
But that's net income, not cash flow yet.
Exactly. Don't stop there. Remember, depreciation was a non-cash expense. To get to after-tax cash flow, we absolutely must add that $10,000 depreciation back to the net income.
So $18,000 plus $10,000.
Equals $28,000. That $28,000 is your project's true after-tax cash flow for the period using this method.
Okay, that makes sense. Fold the income statement, then add back depreciation. What's method two?
Method two is the direct cash flow approach. Many people find this one maybe a bit more intuitive because it directly builds up the cash components without going through net income first.
How does it work?
You start with the cash inflows, the $40,000, but you immediately consider them after taxes. If the tax rate is 40%, the company effectively keeps 60% of that cash inflow.
Oh, right. 1 minus 40%.
So $40,000 times 60% is $24,000. That's your after-tax cash from operations.
Okay.
Then you directly add in the depreciation tax shield we calculated earlier. Remember, the $10,000 depreciation expense, when multiplied by the 40% tax rate, provides a tax saving, or shield, of $4,000.
The 10K times 40%.
Got it. So now just add those two cash components together, the $24,000 from the after-tax sales inflow plus the $4,000 from the depreciation tax shield.
And you get $28,000 again.
Exactly. Same result. So we connect this back to the bigger picture. Understanding this calculation and really seeing how both methods logically arrive at that same crucial $28,000 result is absolutely fundamental. It underpins all the subsequent financial models we're about to explore.
It really is the bedrock upon which all these capital budgeting decisions are built. Seeing it work both ways really helps cement it.
Definitely. Once you get the hang of calculating after-tax cash flow, the rest becomes much easier.
Okay, that side-by-side comparison of the two methods truly illuminates how those after-tax cash flows are derived and why they're so incredibly vital. Now, to really lock this understanding in place, let's walk through a more comprehensive real-world application. Let's use the Carlin Company example from our source material.
Sounds good. This one should tie together the initial investment, the operations, and the disposal stage quite nicely.
Perfect. So Carlin Company is proposing to buy a new machine. Let's focus first on that critical initial investment phase.
Okay.
The core purchase price for this machine is listed as $425,000. But as we know now, that's probably just the starting point, isn't it?
Almost certainly. There are usually other costs to get it operational.
Right. And Carlin incurs several other immediate direct cash outflows here. There's $10,000 just for shipping, getting it to their factory floor.
Mm-hmm.
Then another $15,000 for the actual installation, getting it properly wired, bolted down, calibrated, integrated into their production line.
Essential costs.
And crucially, they're also investing $6,000 upfront for initial training, because you can't just drop a complex new machine in and expect everyone to magically know how to use it safely and efficiently.
Very true. Training is key.
So when you add all these direct cash outflows together, the $425,000 for the machine itself, plus the $10,000 for shipping, plus the $15,000 for installation, plus that $6,000 for training, what do we get?
Let's see, 425 plus 10 plus 15 plus 6, that comes out to $456,000.
Exactly. A total initial outflow of $456,000.
Right.
That's the real all-in cash hit right at the beginning, time period 0 for this project. It's a substantial upfront commitment.
No doubt about it.
Okay, initial investment nailed down. Now let's transition to years 1 through 5. This is the core operational period for the machine. What happens here?
All right, operations. Carlin expects this new machine to produce 4,000 units every year. Each unit sells for $800, and its direct prime costs, materials, labor directly associated with making it, are $750 per unit.
So the contribution margin per unit is $800 minus $750. That's $50 per unit.
Correct. Multiply that $50 contribution per unit by the 4,000 units produced and sold each year.
50 times 4,000. That's $200,000. Is that the annual cash flow?
That's the net cash flow from sales each year, yes. $200,000, but we're not done yet, remember.
Oh, taxes and depreciation. Right.
This is first. Carlin's tax rate is 40%. So the taxes on this $200,000 operational cash flow are $200,000 multiplied by 0.40, which is $80,000 per year.
Okay, so the after-tax cash flow from sales is $200,000 minus $80,000.
Yeah.
That's $120,000.
Correct. $120,000 after tax from the direct operations. But now we need to add back that crucial net indirect effect of depreciation, the tax shield.
Right. How do we calculate that here?
The total depreciable basis for the machine is its full initial cost, which we calculated as $456,000. The problem states it's depreciated straight line over 5 years.
Okay, so $456,000 divided by 5 years.
Comes out to $91,200. That's the annual depreciation expense for accounting purposes.
And the tax shield from that?
Is that $91,200 annual depreciation multiplied by the 40% tax rate. $91,200 times 0.40 equals $36,480. That's the annual cash saving from the depreciation tax shield.
So we add that $36,480 tax shield back to the $120,000 after-tax sales cash flow.
Exactly. $120,000 plus $36,480 gives us a total net inflow per year for each of years 1 through 5 of $156,480.
$156,480 per year for 5 years. That's the steady, reliable annual cash generation Carlin can expect from this project during its main operating life.
All right, year 6. Now, for this final year, the net cash flow from sales and the associated taxes from operations technically remain the same as in the prior operating years.
So still the $200,000 inflow minus the $80,000 tax, yielding $120,000 from operations.
Yes, that part stays consistent based on the info given. However, here's a really crucial point. There is no depreciation expense in year 6.
Why not?
Because the machine was fully depreciated using a 5-year straight-line method. By the start of year 6, its book value is 0. No more depreciation, therefore no more depreciation tax shield in that final year.
Ah, okay. That makes sense. But the machine is still there. Does it have any value left?
It does. The problem states it has an estimated salvage value of $7,000 at the end of year 6.
Okay, so they get $7,000 cash.
They get $7,000 cash, yes. But we need to think about taxes again. Since the entire asset amount was already depreciated down to 0 on the books, this entire $7,000 received from selling it is considered a taxable gain.
Ah, okay. So they have to pay tax on that $7,000.
Correct. Carlin will receive the $7,000 cash, but the net cash inflow is after tax. If the tax rate is 40%, they effectively keep 60% of that gain.
So $7,000 multiplied by 0.6 year, that's $4,200.
$4,200 is the after-tax cash inflow from the salvage value.
Okay, so for year 6 in total, we add this $4,200 after-tax salvage value inflow to the $120,000 from operations.
Right, $120,000 plus $4,200 gives a total inflow for year 6 of $124,200.
$124,200. Slightly less than the operating years because there's no depreciation shield, but partially offset by the salvage value.
Precisely. So what does this all mean when you lay it all out? The Carlin Company example gives us that truly complete, detailed picture. You see all the cash flow impacts across the project's entire 6-year lifespan.
Yeah, you see the big outflow at the start.
The $456,000 outflow at year 0.
Then the steady inflows during its operational heart.
The $156,480 per year for years 1 to 5.
And finally, those unique cash flows tied to its final disposition in year 6.
The $124,200 in year 6. It really is the entire financial story laid bare, from cradle to grave in cash flow terms.
Fantastic. Getting that complete cash flow picture is clearly step 1.
Exactly. And building directly on that absolutely fundamental understanding of correctly identifying and calculating those after-tax cash flows, let's now transition. Let's talk about what is widely, and I think rightly, regarded as the gold standard of capital budgeting methods.
Okay, the gold standard. That sounds important.
It is. We're talking about the net present value method, usually just called NPV.
NPV. Heard that acronym a lot.
You probably have. It's a powerful technique, and it falls under this broader umbrella of approaches called discounted cash flow, or DCF
Yeah,
methods.
DCF, okay. And what's the main goal of these DCF methods, including NPV?
The overarching objective of any DCF method is really to rigorously focus management's attention on two key things. First, the relevant cash flows, we just spent all that time calculating. And second, making sure those cash flows are appropriately discounted to their present value.
Okay, let's pause on that idea of present value.
Hmm.
Can you break that down simply? What does it really mean?
Sure, it's a really profound concept, actually, but simple at its core. It's the idea that a dollar you have in your hand today is worth more than a dollar you expect to receive a year from now or 5 years from now.
Why is that? Inflation.
Inflation is part of it, yes. The purchasing power of that future dollar might be less. But it's also about opportunity cost, which I mean if you could invest that dollar today and earn a return on it.
Right. If I have it now, I can make it grow.
Exactly. And there's also just the inherent risk of future uncertainty. Will you actually get that dollar in 5 years? So discounting is the mathematical process we use to translate all those future cash flows, whether they're e-flows coming in or outflows going out, back to what they're worth in today's equivalent value.
So you can compare everything on a level playing field, basically. Apples to apple.
Precisely. It allows for a true apples-to-apples comparison of costs and benefits that occur at completely different points in time. Without discounting, comparing a cost today to a benefit 5 years from now is misleading.
Okay, and how do you do the discounting? You need some kind of rate,
Yeah.
right?
Absolutely. The rate used to perform this discounting is known as the discount rate, or sometimes the hurdle rate, and choosing the right rate is absolutely critical.
What rates do companies typically use?
Well, management might use the company's overall weighted average cost of capital, the WACC.
WACC, that sounds familiar. What does that represent again?
WACC effectively represents the average rate of return demanded by all of the company's investors, looking at both its debt holders and its equity holders, weighted by how much of each type of capital the company uses. It's like the company's average cost for all its funding.
Okay, so that's one option. Are there others?
Yes. They might use a specific target rate of return that they assign to all new projects, or perhaps more sophisticatedly, they might use a rate that's adjusted specifically for the unique risk profile of the particular project being considered. A riskier project might demand a higher discount rate.
That makes sense. Higher risk, higher required return.
Exactly. No, it's worth noting. While traditional, simpler DCF methods sometimes assume a single constant interest rate or discount rate throughout a project's entire life.
Yeah.
It's vital to acknowledge that in the real world, things change, actual interest rates fluctuate, market conditions evolve, maybe even the project's own risk profile changes over its lifespan. Assuming one single rate forever can be a bit unrealistic.
So how does NPV handle that?
That's one of its strengths. As we'll see, the NPV method actually possesses the flexibility to effectively account for such variations. You can use different discount rates for different periods if needed, making it uniquely robust and realistic.
Okay, that flexibility is definitely a point in its favor. So NPV focuses on present value. What's its core objective then? What question is it trying to answer?
Its core objective is really to focus a decision-maker's management on the initial investment amount that's required to acquire a capital asset, and specifically whether that asset will genuinely yield returns in excess of a management-designated hurdle rate.
In excess of the minimum required return.
Precisely. And what this fundamentally means, and this is key, is that NPV emphatically emphasizes the absolute dollar amount of return generated by a project.
Not just a percentage.
Not just a percentage return like we'll see with another method called internal rate of return, or IRR. And it's not simply about how quickly you get your initial money back, like we'll discuss with payback methods.
So NPV gives you a dollar figure.
Yes, it provides a direct, unambiguous answer to the ultimate bottom line question. How much actual value, measured in today's dollars, will this project realistically add to our company's overall wealth? It cuts straight to the economic heart of the decision.
That sounds incredibly powerful. A clear dollar value of impact. So how do we actually calculate this crucial NPV figure? What are the steps?
It actually boils down to 3 pretty clear actionable steps. Step 1. You meticulously estimate all the relevant cash flows, both inflows and outflows, throughout the entire life of the investment. And crucially, these must be the after-tax cash flows we worked on earlier.
Including the depreciation tax shield.
Absolutely. Got to include that depreciation tax shield. Now, here's a vital point for step one. You ignore any financing costs, like interest expense on debt used to fund the project.
Ignore interest. Why? Isn't that a real cost?
It is a real cost, but it's already implicitly captured within the discount rate you're going to apply in the next step.
Yeah.
Including it explicitly in the cash flows and in the discount rate would be double counting the cost of financing.
Okay. Good point. Avoid double counting.
Yeah.
So estimate all relevant after-tax operating cash flows, ignore financing costs. Step 2.
Step 2, you take all those cash flows you just estimated, the initial outflows, the ongoing inflows and outflows during operations, the final disposal flows, and you discount each one individually back to its present value.
Using that discount rate or hurdle rate we talked about.
Exactly. You use the appropriate discount factor, which is mathematically derived from your chosen hurdle rate and the specific timing of each individual cash flow. A cash flow in year 5 gets discounted more heavily than one in year 1.
Okay. Discount every single cash flow back to today.
Okay.
Then what? Step 3.
Step 3 is the final calculation, and it's straightforward. You simply sum up the present values of all your cash inflows, and then you subtract the sum of the present values of all your cash outflows, including that initial investment at time 0. The result is the net present value.
So PV of inflows minus PV of outflows equals NPV.
That's it. What's really fascinating here and powerful is that the NTE method effectively takes all those disparate future cash flows happening at all different points in time and translates every single one back into a common present-day value. It's like asking, what is this entire project truly worth to us right now in today's dollars after accounting for the timing and risks of all future costs and benefits?
Okay, so you crunch the numbers, you follow the steps, and you arrive at a single NPV figure. How do you interpret it? What does the number actually tell you?
The interpretation is both straightforward and, frankly, profoundly impactful for decision-making. If you get a positive result, meaning the calculated NPV is greater than 0,
Good news.
very good news. It's a clear signal. It tells you that the project's expected rate of return is greater than your hurdle rate, that minimum acceptable return threshold.
So you should do the project.
In this highly desirable scenario, the unequivocal recommendation is make the investment. If a company happened to have the luxury of unlimited funds, which is rare, but theoretically,
Yeah, theoretically.
the optimal strategy would be to accept every single project that yields a positive NPV, because each and every one directly increases the market value of the firm's equity. It genuinely adds wealth to the company and its shareholders.
Okay. What if the NPV is negative? Less than 0.
If you get a negative result, it indicates the opposite. The project's projected rate of return is less than your hurdle rate. It doesn't clear the bar.
And don't do it.
Exactly. In this case, the decision is equally clear. Do not make the investment. It simply doesn't meet management's minimum required return, and undertaking it would actually diminish shareholder value. It would make the company poorer in present value terms.
And what if it comes out exactly 0?
If the NPV calculates out to be exactly 0, management would technically be indifferent. The project is projected to earn exactly the hurdle rate, the minimum required return. It neither adds nor subtracts value beyond that minimum requirement.
So maybe do it, maybe not. Depends on other factors.
Could depend on strategic factors, yes. But purely financially, it's breaking even against the required return. Now, here's where it gets really interesting, connecting back to why it's the gold standard.
Yeah.
NPV directly tells you if a project adds absolute dollar value to the company. That's its unique power, which is why it's almost universally regarded by finance professionals as the most robust and economically sound method for making these critical capital budgeting decisions. It cuts through percentages and timeframes and shows the true wealth creation impact.
That focus on absolute dollar value is key. Now, you mentioned the hurdle rate several times. That rate itself isn't just pulled out of thin air, right? That can be adjusted.
Oh, absolutely. That critical hurdle rate itself isn't some arbitrary static number. It's a dynamic element that can, and frankly should, be adjusted based on circumstances.
So remind us again, what does it represent?
At its core, a hurdle rate is essentially the company's cost of capital. It represents the opportunity cost of investing in this particular project versus investing that same capital elsewhere, maybe in another project or even just returning it to investors. Or it could simply be the minimum required rate of return set by management policy.
And how can it be adjusted?
These rates can be strategically modified, and typically adjustments mean increasing the rate. Why? To appropriately adjust for factors like higher perceived project risk or maybe anticipated future inflation.
So a riskier project needs a higher hurdle rate.
Exactly. A project deemed significantly riskier than the company's average operations might require a higher hurdle rate. It means that project has to promise an even greater return just to be considered acceptable to compensate for that extra uncertainty.
And how does using a higher rate affect the calculation?
A higher discount rate will discount those future cash flows more aggressively. It makes their present value smaller. So using a higher hurdle rate makes it inherently harder for a project to achieve a positive NPV and get accepted. It reflects the idea that the company demands a greater premium, a higher return, for taking on more uncertainty.
Or for investing when inflation might erode future returns?
Precisely. If high inflation is expected, future dollars will be worth less, so you need a higher nominal return just to maintain real value. Adjusting the hurdle rate upwards accounts for that too.
And you mentioned NPV's flexibility allows for different rates over time.
Yes, that's another key advantage. NPV allows for remarkable flexibility. You can apply different discount rates to different time periods within the same project analysis.
Like, how would that work?
For example, management might feel the first few years of a project are fairly predictable, so they use, say, a 12% discount rate. But they might anticipate much higher uncertainty or risk further out, maybe in years 4 and 5. So they could strategically jump the discount rate to, say, 15% just for those later, riskier years.
Wow, okay. NPV can handle that.
Seamlessly. This inherent capability really highlights why NPV is often considered superior to the internal rate of return, or IRR in this specific regard.
Why is that? What's the issue with IRR?
Because NPV can easily handle these inconsistent or fluctuating rates of return over a project's life. IRR, as we'll discuss later, is fundamentally limited because it implicitly assumes a single, consistent rate of return and reinvestment throughout the entire project, which, as we said, can be unrealistic. NPV doesn't have that limitation.
That's a major advantage for NPV in complex situations.
Yeah.
What about investments that aren't really optional, like, say, a legally required safety upgrade?
Great question. For certain investments that are, let's say, qualitatively desirable or perhaps even non-optional, maybe a government-mandated environmental upgrade, or a critical technology infrastructure overhaul that the company simply must do to stay in business.
Yeah, things you have to do.
Right. For those kinds of investments, the discount rate used for the NPV evaluation isn't necessarily the company's high WACC or some risk-adjusted hurdle rate reflecting potential returns, because the decision isn't really should we generate a high return from this.
The decision is, we have to do this.
Exactly. So the core decision shifts from should we invest to what's the most cost-effective way to finance this unavoidable investment. In those cases, the relevant discount rate to use when comparing financing options, like borrowing versus leasing to acquire the mandated asset, should typically be the company's after-tax cost of borrowing.
Because you're just trying to find the cheapest way to fund something you have to do anyway.
Precisely. It's about minimizing the cost of a necessary expenditure.
Okay, that detailed explanation of the hurdle rate and NPV's flexibility, especially with varying rates and non-optional projects, truly underscores why it's considered so powerful. Now that we really understand the nuances of NPV, let's put it all together again. Let's walk through another comprehensive real-world application, the McLean Inc. NPV example.
Okay, let's do it. McLean Inc.
So McLean is considering purchasing a new machine. It costs $150,000 up front. It has a useful life of 3 years.
3 years. Okay.
For depreciation, they're using a specific accelerated schedule, not straight line this time. The problem states they depreciate 30% of the cost in year 1, then 40% in year 2, and the remaining 30% in year 3.
Okay, 30, 40, 30 depreciation pattern. Got it.
At the end of its 3-year life, it's estimated to have a $10,000 resale value, or salvage value.
$10 salvage at the end of year 3?
And the whole point of this machine is that it's expected to save McLean $85,000 per year in operating expenses. So it's a cost-saving investment.
$85,000 annual savings. That's a primary inflow driver.
McLean's tax rate is 40%, and their minimum acceptable rate of return, their hurdle rate for this project, is set at 16%.
40% tax, 16% hurdle rate.
Okay, and we're also given the specific present value discount factors for a 16% rate for each of the 3 years, which makes the math easier.
Perfect. Let's break it down step by step now. Where do we start?
Well, first, let's figure out that annual depreciation tax shield, that important indirect cash inflow. It varies each year because the depreciation amount changes.
Right. So year 1 depreciation is 30% of the $150,000 cost. That's $45,000.
Okay, and the tax shield.
Multiply that $45,000 depreciation by the 40% tax rate. $45,000 times 0 dollars for ZEC gives a tax shield of $18,000 in year 1.
Got it. Year 2.
Year 2 depreciation is 40% of $150,000. That's $60,000. Multiply by 40% tax rate. The tax shield is $24,000 in year 2.
$24,000. Okay.
And year 3.
Year 3 depreciation is the remaining 30% of $150,000, so back to $45,000 in depreciation expense. Multiply by 40% tax rate gives us another $18,000 tax shield in year 3.
Okay, so tax shields are $18K, $24K, $18K for the 3 years. Those are critical positive cash flow impacts that effectively reduce the real cost of owning the asset.
Absolutely essential to include them. What's next?
Second, let's determine the annual operating expense savings, but after tax. The machine saves $85,000 per year before tax.
Right. So to get the after-tax savings, we multiply that $85,000 by 1 minus the tax rate. So $85,000 multiplied by 1 minus 0.40, which is $85,000 times 0.60.
Comes out to $51,000. That's the annual after-tax cash inflow from the cost savings each year for all 3 years. A direct cash benefit from the improved efficiency.
$51,000 per year. Got it. Third step.
Third, we need to account for that salvage value inflow, but only at the very end in year 3.
Right. The $10,000 resale value, is that taxed?
Yes. The problem implies the accelerated depreciation, 30 plus 40 plus 30 was 11%, fully depreciates the asset down to a 0 book value by the end of year 3. So that entire $10,000 received from selling it is considered a taxable gain.
Ah, okay. Fully depreciated means any salvage is a gain.
Usually, yes. So the after-tax cash inflow from salvage is the $10,000 cash received multiplied by 1 minus the 40% tax rate.
$10,000 times 0.60 equals $6,000. That's the final cash injection in year 3 only.
Correct. $6,000 after tax from salvage in year 3.
Okay, we have all the pieces. Initial cost, annual savings, varying tax shields, and salvage value. Now we assemble the net present value schedule, bringing everything back to today's value using that 16% hurdle rate.
Let's lay it out. Year 0 first.
Year 0. The initial equipment cost is a direct cash outflow of $150,000. The discount factor for year 0 is always 1.00, right? Because it's already in present value.
Correct. So its present value is simply $150,000. That's our starting point.
Okay. Now, year 1. What are the total cash flows?
In year 1, we sum the depreciation tax shield of $18,000 and the annual after-tax operating savings of $51,000.
So $18K plus $51K yields $69,000 total after-tax cash flow in year 1.
Right. Now we multiply the $69,000 by the year 1 present value factor given for 16%, which is 0.862.
$69,000 times 0.862 equals $59,478. That's the PV of year 1's cash flows.
Exactly. Now for year 2.
Year 2, the depreciation tax shield was higher, $24,000, plus the same annual savings of $51,000. Total is $75,000 after-tax cash flow.
Correct. We multiply the $75,000 by the year 2 PV factor at 16%, which is given as 0.743.
$75,000 times 0.743 equals $55,725, the PV of year 2's cash flows.
Perfect. And finally, year 3.
Okay, year 3. We have the depreciation tax shield back down to $18,000, plus the annual savings of $51,000.
Yeah.
And don't forget that after-tax salvage value inflow of $6,000.
Right. Add them all up. $18,000 plus $51,000 plus $6,000. That sums up to a total of $75,000 in after-tax cash flow for year 3.
Same total as year 2, interestingly. Okay, now we multiply the $75,000 by the year 3 PV factor at 16%, which is 0.641.
$75,000 times 0.641, resulting in a present value of $48,075 for year 3.
All right, we have the present value of the initial cost and the present values for all the inflows in years 1, 2, and 3. Now, to find the grand total net present value, we just sum them all up.
Exactly. We take the initial outflow of $150,000 plus the PV of year 1 inflows, $59,470, plus the PV of year 2 inflows, $55,725, plus the PV of year 3 inflows, $48,075.
Okay, let's add those positives. $59,478 plus $55,075. That comes to $163,278 in total PV of inflows.
Right. Now subtract the initial costs PV. So $163,278 minus $150,000.
Gives us a positive net present value of $13,278.
So what does this all mean for McLean Inc.? What's the verdict? A positive NPV, even if it's not enormous, is a clear go signal. It indicates that this project is expected to generate a return greater than the company's required 16% hurdle rate.
And the $13,278 number itself.
That signifies that this specific investment is projected to genuinely add $13,278 in today's dollar value to McLean's overall shareholder wealth. It creates value. So based on NPV, this project should absolutely be undertaken. It's a financially desirable project.
That McLean example really pulls it all together beautifully. It shows why NPV is often considered the best technique.
It does. Its primary advantage, as we've really seen demonstrated, is that inherent flexibility. It can seamlessly handle inconsistent rates of return like the accelerated depreciation or varying cash flows year by year. That's a huge real-world benefit because perfect uniformity in cash flows is pretty rare.
And it gives that clear quantitative measure of value creation in dollars.
Exactly. But it does have, a particular limitation we should acknowledge. NPV doesn't directly tell you the project's true rate of return as a percentage. It only gives you that specific dollar amount of added value, the $13,278 in this case.
So if you wanted to know the percentage return,
That's where some of the other methods, like IRR, can offer a complementary perspective, even with their own limitations. NPV tells you how much value, not necessarily the rate at which you're earning it relative to the investment size.
got it. So NPV is great for value, maybe less intuitive for rate. Now, what happens if McLean had, say, 5 projects like this, all with positive NPVs, but they didn't have enough money to do all of them?
That's a very common real-world scenario. That brings us to the concept of capital rationing.
Capital rationing. Sounds like what it is, rationing capital.
Exactly. It describes that very common situation where a company identifies multiple potentially valuable projects, maybe several with positive NPVs, but they simply have limited investment resources available.
Like a fixed budget for new projects for the year.
Precisely. Maybe a fixed annual budget set by the board, or perhaps restrictions on how much new debt they can realistically take on. Resources are finite.
So in that ideal world you mentioned, with unlimited capital,
If a company truly had unlimited capital, the rule is simple. Pursue every single project with a positive NPV because each one genuinely adds value. Maximize total value.
but in the much more realistic scenario where capital is limited,
Then managers face a much more challenging optimization problem. They can't do everything. They must meticulously allocate that scarce capital to the specific combination of projects that will achieve the maximum possible total net present value for the company overall, given their budget constraint.
so it's about picking the best mix of projects to get the biggest bang for their limited buck.
You got it. Biggest bang for the buck in NPV terms. It requires careful selection and prioritization.
This sounds like a place where another tool might be helpful.
Sure.
How do you prioritize effectively?
This is precisely where the Profitability Index, or PI, steps in as a really valuable tool, specifically designed for these capital rationing situations.
Okay, the Profitability Index, PI, what is it?
The Profitability Index is actually a pretty simple but powerful ratio. It's calculated as the present value of the net future cash inflows, divided by the present value of the net initial investment.
TV of inflows divided by PV of initial outflow.
Essentially, yes. Sometimes you might hear it called the Excess Present Value Index, but PI is more common.
And how do you interpret the PI ratio?
The interpretation is quite straightforward. A PI greater than 1.0 simply means that the present value of the project's expected inflows is greater than the present value of its initial cost or outflows, which logically signals a financially desirable project. It's the same condition as a positive NPV.
So PI1 means positive NPV.
Exactly, they move together. But the PI's core application, especially in capital rationing, is different. It aims to measure the relative cash flow return generated per dollar invested.
The bang for the buck metric.
Precisely. The higher the PI, the more desirable the project is relative to its cost. It shows which projects give you the most discounted future inflow for each dollar you invest today.
So how does that help with rationing?
When capital is truly limited, the standard approach is to calculate the PI for all available acceptable projects, those with PI1 or positive NPV. Then you rank them strictly by their PI, from the highest PI down to the lowest.
Ranked them by bang for buck.
Yep. And then you start investing down that rank list, accepting projects in that precise order until your allocated capital budget is fully used up. It's a very practical, systematic way to make those tough choices when you can't fund everything.
Okay, let's see this in action. Let's use the Beeman Enterprises example.
Sounds good. Beeman Enterprises.
Beeman has a total budget constraint of just $50,000 available to invest in new projects this year. And they have 5 potential projects they've analyzed labeled A, B, C, D, and D.
5 projects, $50 K budget limit.
For each project, we know its initial investment cost, which we'll assume is its PV of outflows, and the calculated present value of its expected future net cash inflows. We need to figure out which combination of projects Beeman should choose to maximize their total value within that $50K budget.
Okay. First step. Calculate the profitability index for each of the 5 projects.
Right. Let's go through them.
PV of inflows is $25,000. Initial investment is $16,000. PI is
$25,000 divided by $16,000. That's a PI of 1.5625 for Project A.
okay. Project B inflows $7,000. Investment $4,000. PI.
$4,000 equals 1.75 for Project B higher.
Project C inflows $38,000. Investment $30,000.
PI. $38,000 is 1.375 for Project D.
And finally, Project E inflows $42,000. Investment $8,000. PI.
$42,000, $25,000 is 1.68 for Project D. Pretty high.
Okay, we have the PIs. A 1.56, B 1.75, C 1.27, D 1.38, equal 1.68, rounding slightly. Now, second step, rank them.
Right. Rank these projects strictly from the highest PI down to the lowest. Based on our calculations, the optimal order looks like this. Project B has the highest PI at 1.75, then Project E is next at 1.68, then Project A at 1.5625, followed by Project D at 1.375, and finally Project C brings up the rear at 1.267.
So the ranking is B, E, A, D, C, highest bang for buck first.
Exactly. Now for the critical third step. We allocate Beeman's $50,000 budget following that precise ranked order. We accept projects sequentially until we hit or can exceed our budget limit.
Okay, let's do it. Start with the top rank, Project B. It costs $4,000. Do we take it?
Yes, $4,000 is well within the $50 K budget, so we accept Project B. Our remaining budget is now $50,000 minus $4,000, which is $46,000 left.
Yes, we have $46,000 left, so $25,000 fits easily. Except Project E, our budget drops to $46,000 minus $25,000, leaving $21,000.
Right. Third in rank is Project A. It requires $16,000. Enough budget. Yes, we have $21,000 remaining, so $16,000 is fine, except Project A. This leaves us with $21,000 minus $16,000, just $5,000 of our initial budget remaining.
Okay, only $5K left. What's the total invested so far?
Let's see. Project B, $4K, plus Project E, $25K, plus Project A, $16. That sums up to $45,000 invested so far.
Right. And the next best project in our ranking is Project D. How much does it cost?
Project D costs $8,000.
Ah. And we only have $5,000 left in the budget.
Exactly. Unfortunately, investing in Project D would push us $3,000 over our $50,000 limit, assuming we can't do partial projects or exceed the budget.
We have to stop here. We can't take Project D. And since C is ranked even lower, we definitely can't take that either.
Correct. Therefore, the conclusion is that Beeman Enterprises will optimally choose to invest only in projects B, E, and A. This combination uses $45,000 of their $50,000 budget and maximizes the total NPV they can achieve given that constraint.
Even though Project C, for instance, had a fairly large inflow, 38K, and was acceptable, PI1, it just didn't provide enough bang for the buck compared to the others to make the cut within the budget.
Precisely. What's truly fascinating here, I think, is how the profitability index acts as this really practical strategic guide. It helps companies make the most economically rational choices when they're faced with those very real constraints of limited capital. It ensures they maximize the overall value created despite those resource limitations.
It ensures every dollar invested generates the highest possible present value return first. Makes a lot of sense. That's a brilliant way to optimize when money is tight. Now, let's pivot slightly and turn our attention to a very common and often quite complex decision that many companies grapple with regularly: the lease versus buy decision.
Ah, yes, the classic lease or buy dilemma. Happens all the time.
It really does. Should a company outright purchase a new asset like that new machine we keep talking about, or should they instead lease it from someone else? The core issue here for making a sound financial decision is really to focus intently on the distinct cash flows created by each of those two options.
Right. You need to carefully analyze the cash implications of leasing versus the cash implications of buying.
And then compare them head to head to figure out which path is truly more financially advantageous for the company. Because, as you said, it's not always as simple as it might look on the surface, is it?
Not at all. And what's absolutely crucial to grasp right at the outset here is that this isn't really just one monolithic decision. It's actually better thought of as two distinct, though intertwined, decisions that ideally should be analyzed separately.
Two decisions hidden within one. Okay, what are they?
First, there's the investment decision itself. This asks the fundamental question: does acquiring and operating this asset actually provide genuine operational benefits to the company? Is it worth having at all?
So ignoring how we pay for it for a moment.
Exactly. For this part of the analysis, you focus purely on the net present value of the after-tax operating cash inflows that the asset itself is expected to generate over its life.
And what discount rate do we use for that?
For this operational benefit analysis, you would typically discount those operating inflows using the company's overall weighted average cost of capital, the WACC. Why? Because WACC reflects the overall operating risk associated with the company's investments. You're essentially asking, is this asset valuable enough from an operational standpoint based on our company's average required return?
Okay, so decision one, is the asset worth having operationally using WACC? What's decision two?
Then, second, and distinctly separate from that investment decision comes the financing decision. This asks, given that we want the asset, assuming the investment decision was positive, is it financially cheaper for us to buy it or to lease it?
Okay, comparing the financing methods.
Right. And this part of the analysis zeroes in on comparing the relative financial benefits. Specifically, you look at the tax allowable depreciation you gain from owning the asset if you buy it versus the tax savings you receive from the lease payments themselves if you lease it, as lease payments are often tax deductible.
And what discount rate do we use for this comparison? Not WACC again.
No, absolutely not WACC for the financing decision. For comparing the financing options, the cash outflows related to buying versus leasing, it's critical that you discount these specific cash outflows using the company's after-tax cost of debt.
After-tax cost of debt, why debt specifically?
Because both buying the asset, often financed with borrowed funds, and leasing the asset are, at their financial heart, forms of financing. They are alternatives to borrowing. Therefore, the relevant comparison rate is the cost of the company's debt financing, adjusted for the tax benefit that interest payments provide. It reflects the cost of the alternative financing source.
Okay, that distinction is really important. WACC for the operational value, after-tax cost of debt for comparing financing methods.
Absolutely. If we connect this to the bigger picture, understanding these two distinct focuses first, the asset's intrinsic operational value, and second, the most cost-effective way to finance obtaining its use is the absolute key. It helps you make the right comprehensive choice, rather than potentially conflating the two decisions into a single, possibly misleading calculation.
And the best financing option is just the cheaper one.
Essentially, yes. The preferred financing option is simply the one that results in the lowest net present value of cost. You calculate the PV of all the cash outflows associated with buying, purchase price minus PV of depreciation, tax shields, and salvage, and compare it to the PV of all the cash outflows associated with leasing, PV of after-tax lease payments. Whichever PV of cost is lower, i.e. less negative, is the financially cheaper route.
Okay, so just to clarify the specific cash flows we're comparing for each financing option, if you choose to buy the asset.
You're primarily looking at the initial purchase cost as an outflow, but then you factor in, as inflows or reductions to cost, the present value of the future tax savings you'll gain from depreciation over the asset's life, and also the present value of any scrap or salvage proceeds you expect to receive at the very end.
Okay. And if you choose to lease the asset instead?
Your focus shifts. The primary cash flows are the periodic lease payments themselves, treated as outflows. But importantly, you also consider the corresponding tax savings you get on those lease payments, since they are typically tax-deductible expenses. So you calculate the present value of the after-tax lease payments.
Got it. Buy involves cost minus PV of tax shield salvage. Lease involves PV of after-tax payments. Now, there's a passkey rule mentioned that ties these two decisions, investment and financing, back together. What's that?
Right, the synthesis. The rule is this. If the net present value of the cost of the best financing option, whichever was cheaper, buying or leasing, is less than the net present value of the operating cash flows that the asset will generate from decision one, then and only then should the overall project be undertaken.
Let me see if I get that. If the asset itself is valuable enough operationally, positive PV of operating inflows using WACC, and the best way to finance it still results in a total PV less than that operational value, then it's a go.
You've got it exactly right. It ensures both hurdles are cleared, the asset generates value, and you can affordably finance it.
Okay, this definitely needs an example. Let's walk through the Boulder Inc. example step by step. This looks comprehensive.
Agreed. Boulder Inc. is a great illustration of putting this all together.
So Boulder is considering getting a new machine. It costs $200,000 if they buy it on January 1, year one.
$200 purchase price.
This machine is estimated to have a scrap value of $25,000 at the end of year two, so it's a 2-year project.
$25K scrap, 2-year life.
Okay. Operationally, it's expected to generate annual operating inflows of $150,000 for those 2 years.
$150K operating inflow per year.
The company's tax rate is 30%.
Yeah.
Their overall weighted average cost of capital, WACC, is 9%. And for simplicity, the machine is depreciated straight line over its 2-year life if purchased.
20% tax, 9% WACC, 2-year straight line depreciation. Got the basics.
Now, the financing options. They can either take out a 10% bank loan to buy it outright,
Option 1, borrow at 10% and buy.
or option 2. They can pay $92,500 in annual lease payments. And crucially, these lease payments are due on January 1st of each year, year 1 and year 2.
Option 2, lease for $92,500 per year paid at the beginning of each year. That's important annuity due.
Right, and we're given the necessary present value factors for both 9% WACC and the relevant financing rate. Okay, where do we start the analysis?
We follow the two-decision process. First, let's determine the operational benefit of the project decision 1. Is this machine worth having from a purely operational perspective before we worry about financing?
Okay. We use the operating inflows and the WACC here.
Right. Correct. The annual operating inflows are $150,000 before tax. The tax rate is 30%. So that after-tax cash inflow is $150,000 multiplied by 1 minus 0.3 year.
$150,000 times 0.70 equals $105,000 per year after tax.
Right. $105,000 per year for 2 years. Now we need to find the present value of this 2-year stream of inflows using the WACC of 9%. Since these are regular end-of-year inflows implicitly, unless stated otherwise for operations, we use the present value of an ordinary annuity factor for 2 years at 9%. The problem gives us this factor is 1.759.
Okay, so $105,000 annual after-tax inflow multiplied by the 1.759 PV factor.
Equals $184,695. This $184,695 represents the present value of the annual after-tax operational cash inflows. It's the value the asset promises to deliver to the business, discounted to the company's overall required return, WACC.
So decision 1 looks positive. The asset seems operationally valuable. Now for decision 2, the crucial financing decision, we need to compare the cost of borrow and buy versus the cost of the operating lease.
Exactly. And for this comparison, what's our appropriate discount rate?
Not the 9% WACC. It has to be the after-tax cost of debt. The bank loan rate is 10% and the tax rate is 30%.
So the after-tax cost of debt is 10% multiplied by 1 minus 0.30, which is 10% times 0.70 equals 7%. This 7% is the critical discount rate we must use to evaluate the cash flows related specifically to the financing options.
Okay, 7% it is. Let's calculate the net present value of the cost for the borrow and buy asset option first.
Right. We need all the cash flows associated with buying.
In year 0, or Jan 1, year 1, the initial cost of the machine is a direct cash outflow of $200,000. Its PV is just $200,000.
Okay, outflow of $200K at time 0. What about inflows or tax shields?
Depreciation, it's $200,000 costs straight line over 2 years. So annual depreciation is $200,000 divided by 2. That's $100,000 per year for year 1 and year 2.
Okay, and the tax shield from that?
The annual depreciation tax shield, that indirect cash inflow, is the $100,000 annual depreciation multiplied by the 30% tax rate. So $30,000 per year in tax savings for both year 1 and year 2.
$30,000 inflow at the end of year 1 and another $30,000 at the end of year 2 from depreciation shield.
Got it.
Anything else if they buy?
Yes, the scrap value at the end. At the end of year 2, they expect to get $25,000 cash from selling it. We need the after-tax amount.
Since it's fully depreciated, 2-year life, 2-year SL depreciation, the $25,000 is likely all taxable gain. So after-tax scrap is $25,000 multiplied by 1 minus 30% tax rate.
$25,000 times 0.70 equals $17,500. This is an inflow at the end of year 2.
Perfect. So summarizing the buy flows,
Yeah.
outflow $200K, or arrow, inflow $30K, or arrow 1, inflow $30K plus $17.05K equals $47 the 5K, or arrow 2. Now we discount these using our 7% after-tax cost of debt.
Right.
We need the PV factors for $1 at 7%. Let's assume year 1 factor is 0.935 and year 2 is 0.873, standard PV factors.
Right.
$200,000 times $1,050.
The total flow is $47,530K shield plus 17.835 times 0.873 equals $41,468.
Great. Now sum these present values to get the NPV of the cost of buying. $200,000 plus $28,050 plus $41,468 equals $130,483. That's the net present value of the total cost if Boulder chooses to borrow and buy. Keep that number in mind, $130,483.
Got it. Now for the alternative, the operating lease option. What are the CASPAs here?
The annual lease payment is $92,500. We need the after-tax cash outflow. Tax rate is 30%.
So the after-tax cash outflow for the lease payment is $92,500 multiplied by 1 minus 0.30, which is $92,500 times 470, equals $64,750 per year.
This is an outflow.
An outflow of $64,750 each year for 2 years. But here's that crucial detail. The payments are due on January 1st each year. Year 1 payment on Jan 1, year 1. Year 2 payment on Jan 1, year 2.
Right. That makes it an annuity due, not an ordinary annuity. The first payment happens right at the start of the period, which is effectively times 0 for the first payment.
Yeah.
And the second payment happens at the start of year 2, which is the same as the end of year 1 in PV terms.
So we need the present value factor for an annuity due at our 7% discount rate for 2 years. The problem gives this factor as 1.935. Okay, so we take the annual after-tax cash outflow of $64,750 and multiply it by the PV of annuity due factor of 1.935.
64,750 times 1.935 gives us a PV of the total after-tax cash outflows for the lease option of $125,291.
$125,291. Okay, now we compare the two financing options.
The PV of the cost of borrowing and buying was $130,483. The PV of the cost of leasing is $125,291.
Since we're comparing costs, outflows, hence negative PVs, the option with the lower cost is the one with the PV closer to 0 or less negative.
Correct. The operating lease is the cheaper financing alternative in this case because its net present value of cost is lower. So based on this analysis, the project should be financed using the operating lease. That's the answer to the financing decision.
Okay, lease wins the financing battle. Now, final step. Determine the net present value of the total investment, integrating both decisions. How do we do that?
We take the PV of the operational inflows we calculated way back in decision 1.
That was $184,695 using the 9% WACC. Right. Then we subtract the PV of the cost of the chosen financing option, which was the lease.
The lease cost PV was $125,291, calculated using the 7% after-tax cost of debt.
So $184,695 PV of operating inflows minus $125,291 PV of lease financing costs equals
$184,695,125,291 equals $59,404.
So what does this all mean for Boulder Inc. in the end? The final conclusion.
This comprehensive analysis tells us two crucial things. First, the project itself creates significant value for Boulder Inc. It has a positive overall NPV of $59,404. And second, the analysis showed that the operating lease is the most cost-effective way for them to finance that valuable investment.
So they should definitely do the project, and they should lease the machine rather than buy it.
Exactly. This maximizes the overall financial benefit and ensures that the operational value created translates effectively into real shareholder wealth. It's a clear path forward. That Boulder example is fantastic for showing how to break down that complex lease versus buy decision. Just a quick final thought on this. How do these choices affect the financial statements? Does leasing look better than buying on the balance sheet?
Well, that's become more complicated recently with changes in accounting standards. Historically, operating leases were often preferred partly because they were off balance sheet. Financing the asset and liability didn't show up directly, making ratios like debt to equity look better.
The old loophole.
Kind of. Buying an asset financed by debt clearly puts both the asset and the debt on the balance sheet, increasing the debt to equity ratio and potentially reducing the interest coverage ratio, which could impact the company's creditworthiness or loan covenants.
And now with operating leases.
Under newer accounting standards like ASC 842 and IFRS 16, most leases, including operating leases, now require companies to recognize a right-of-use asset and a corresponding lease liability on the balance sheet. It's not identical to owning, but it brings leases much more into the open.
So the off-balance sheet advantage is mostly gone.
Largely, yes, though the specific income statement and cash flow statement treatments can still differ between operating and finance leases, which are economically closer to purchases. The key takeaway, though, regardless of the accounting nuances or the financing decision made, buy or lease, is that the underlying hope and expectation are always the same.
Which is?
That the company will generate enough actual profits and positive cash flows from operating the asset to comfortably offset any negative impacts on those important financial ratios, ensuring the long-term financial health and viability of the business. The economics should drive the decision, ideally.
That deep dive into NPV and its really practical applications like the lease versus buy decisions truly highlights its immense power. It's really clear why it's often called the gold standard.
It really is the benchmark.
But as you mentioned, while NPV gives us that crucial absolute dollar value impact, there are other key capital budgeting methods out there, and they offer different, sometimes equally valuable perspectives, right?
Absolutely. NPV isn't the only tool in the toolbox, though it's often the most important one.
So let's talk about one we've already mentioned a few times, the internal rate of return, or IRR.
Okay, IR.
What's the main objective of the IRR method? What is it trying to tell us?
The objective of IRR is fundamentally different from NPVs. It aims to calculate the expected rate of return of a project, expressed as a percentage. Specifically, the IRR is the unique discount rate that, if you plugged it into the NPV calculation for that project, would make the net present value come out to exactly zero.
So it's the discount rate where the project breaks even in present value terms.
Precisely. It's the exact discount rate where the present value of all the expected future after-tax cash inflows perfectly equals the present value of the initial investment or outflows.
So unlike NPV focusing on dollar amounts, IRR focuses decision makers squarely on percentages. It answers the question, what annual rate of return is this project actually expected to generate on our investment?
That's exactly its focus. It gives you a rate, a percentage return.
And how do you use that rate to make a decision?
The decision rule for IRR mirrors the NPV rule, but using rates. You compare the calculated IRR percentage to your predetermined hurdle rate, which, remember, represents your minimum acceptable rate of return.
So if IRR is higher than the hurdle rate,
You accept the project. The project's expected return exceeds your minimum requirement.
if IRR is lower than the hurdle rate,
You reject the project. It doesn't meet the minimum threshold.
and if IRR happens to be exactly equal to the hurdle rate,
Then, just like with an NPV of 0, management would technically be indifferent based purely on the financial metrics. It's earning exactly the required return, no more, no less.
okay, so IRR gives you that percentage return, which feels pretty intuitive. People like thinking percentages, but you hinted earlier that it has some significant limitations.
It does. And while understanding a project's percentage return is definitely intuitively appealing, IRR has some really important drawbacks that managers absolutely need to be aware of, because they can sometimes lead to flawed or misleading conclusions, especially when comparing mutually exclusive projects.
Okay, what's the first major limitation?
One of the biggest ones is what's often called the unreasonable reinvestment assumption.
Unreasonable reinvestment. What does that mean?
The core IRR calculation implicitly assumes that any positive cash flows generated by the investment during its life, those intermediate inflows before the project ends, are immediately reinvested back into the company and earn a return equal to the internal rate of return itself.
Okay. Why is that unreasonable?
Well, think about it. If your project calculates out to have a very high IRR, say 30%, or maybe an unusually low one, like 5%, is it really realistic to assume that the company can consistently find other investment opportunities that will yield exactly that same 30% or 5% return for all those intermediate cash flows?
Probably not, especially if the IRR is very high or very low compared to normal market returns.
Exactly. Finding consistent 30% reinvestment opportunities might be impossible. This potentially unrealistic assumption can lead to an inflated, if IRR is high, or maybe deflated, if IRR is low, view of the project's true overall profitability. And crucially, it can really distort comparisons between projects if they have different cash flow patterns or different IRRs. NPV, by contrast, implicitly assumes reinvestment at the discount rate, the hurdle rate, or WACC, which is generally considered a more reasonable and achievable benchmark.
That's a really subtle but important difference in assumptions. Okay, what's another limitation of IRR?
Another issue stems from its, sometimes inflexible cash flow assumptions, particularly when dealing with complex projects. The standard IRR method can become less reliable or potentially even yield multiple different IRR solutions for the same project if you have several alternating periods of net cash inflows and net cash outflows over the project's life.
You mean like positive flow one year, negative the next, then positive again?
Exactly. What finance people call non-conventional or non-normal cash flows. Or it can also struggle sometimes when the amounts of those cash flows differ very significantly over time. IRR can sometimes get confused by these more complex but often very real-world cash flow patterns that NPV, with its direct discounting approach, handles with relative ease.
So IRR works best with simple, conventional cash flows.
Generally, yes. It's most reliable then. And perhaps the most critical limitation, especially when comparing projects, is that IRR evaluates alternatives based entirely on the interest rate, the percentage return.
And the problem with that is?
It means it can sometimes fail to adequately consider the absolute dollar impact of the project, particularly when you're comparing projects of vastly different sizes or scales.
Can you give an example?
Sure. Yeah. Let's revisit that quick example from earlier. Imagine you have two mutually exclusive projects, meaning you can only choose one. Project A requires a tiny investment, just $50. but it generates a fantastic $100 return fairly quickly. That's an incredible 200% return, a sky-high IRR.
Wow, 200% sounds amazing.
Now, consider Project B. This one requires a much, much larger investment, say $50,000. But it generates a very respectable return of $25,000. That's only a 50% return. Still great, but a much lower IRR than Project A's 200%.
Okay, so IRR says Project A is way better, 200% views 50%.
Exactly. If you were only looking at the IRR percentage, you'd jump all over Project A because 200% blows 50% out of the water.
Yeah.
But think about the actual value created. Project A, despite its amazing percentage return, only puts an extra $100 into your company's pocket. Project B, even with its lower 50% return, puts significantly more actual dollars, a whole $25,000 into the company's wealth.
NPV would clearly favor Project B in that case, wouldn't it?
Yeah.
Because the dollar of value added is much larger.
Absolutely. NPV would show a much larger positive value for Project B. This really raises that important question for any decision maker using these tools.
Yeah.
While a percentage return like IRR is definitely intuitive and easy to grasp, it can sometimes profoundly mislead you, especially when the scale of the investments varies greatly. It really forces you to ask, is my primary goal here to optimize for the highest rate of return, regardless of size? Or is it to maximize a total dollar value creation for my shareholders?
And usually the goal is maximizing dollar value, right? Which points back to NPV.
For most publicly traded companies focused on shareholder wealth maximization, yes, NPV aligns better with that goal. That's the core insight behind this crucial limitation of IRR.
Okay, those limitations are absolutely critical to understand. It really highlights why just chasing the highest percentage isn't always the smartest strategy.
Okay.
Now, let's shift gears again to a much simpler but still very widely used method, the payback period method.
Payback.
Yeah.
Simple, intuitive, and quick.
Exactly. What's the objective here? What does payback tell us?
The objective is wonderfully straightforward. The payback period is simply the amount of time usually measured in years required for the cumulative net after-tax operating cash inflows generated by a project to completely recover the project's initial investment cost.
So it's just about how fast you get your initial money back.
That's precisely it.
Yeah.
How quickly does the project pay back its upfront cost? This method places a very strong emphasis on two key aspects: liquidity and risk.
Liquidity and risk. How so?
Companies, especially those maybe operating with tight cash flows or in very uncertain environments, often show a strong preference for projects with a shorter payback period. Why? Because it means they get their initial capital back into the company's coffers faster.
Which reduces the time their money is tied up and exposed to risk.
Exactly. It reduces the time their principal investment is exposed to the risks of the project failing or the market changing. So a shorter payback is often seen as less risky and better for liquidity. It's fundamentally about how quickly you can get your initial stake out of the game.
Makes sense. How do you calculate it? Is it complicated?
Not usually. If you're lucky enough to have a project that generates perfectly equal, uniform annual cash flows each year, the formula is incredibly simple. You just take the net initial investment amount and divide it by the average or constant incremental cash flow per period.
Initial investment divided by annual cash flow. Simple division.
Yep. Now, when we talk about the cash flow assumptions for the basic payback method, we generally assume those uniform inflows each period to use that simple formula. And importantly, depreciation is only considered to the extent that it provides that cash-saving tax shield. We need the after-tax cash flow number, not accounting profit, because we're focused entirely on actual cash recovery.
Right, cash in versus cash out. Let's apply this with the Helena Company example.
Okay, Helena Company.
Helena is acquiring a machine for $250,000. This machine is expected to reduce their annual operating costs by $80,000 per year. So that's like an inflow.
$250K cost, 80 Terry annual savings.
The machine is depreciated straight line over 5 years, and it has no salvage value at the end. The company's tax rate is 40%. We need the payback period.
Okay. First step, as always, is to calculate the annual net cash savings, which is our relevant after-tax cash flow number.
Right. The expected cash flow savings from reduced operating costs are $80,000 per year.
Good start. But we need to factor in taxes and depreciation's impact.
Okay, so from that $80,000 cash saving, we first subtract the annual depreciation expense for accounting purposes to figure out the taxable income. The cost is $250K, 5-year straight line. So depreciation is $250,000 divided by 5 years equals $50,000 per year.
Right. So the net income before tax is the $80,000 cash savings minus the $50,000 depreciation expense, which leaves $30,000 in taxable income.
Got it. Now apply the 40% tax rate to that $30,000 taxable income. $30,000 times 40% equals $12,000 in taxes.
Okay. Subtracting those taxes, we get $30,000 minus $12,000 equals $18,000 in net income. But we're not done.
Right. Payback needs cash flow. So we have to add back that non-cash depreciation expense of $50,000.
Exactly. Add back the depreciation. So $18,000 net income plus $50,000 depreciation gives us our total annual net cash savings, or true after-tax cash flow, of $68,000 per year.
$68,000 annual after-tax cash flow. Perfect. Now, how do we calculate the payback period?
Since the cash flows are uniform, $68K every year, we use the simple formula. Initial investment divided by annual cash flow.
So $250,000 initial investment divided by $68,000 annual net cash savings.
$250,000, $68,000 comes out to approximately 3.68 years.
3.68 years. So Helena can expect to recover their initial $250,000 investment in just under 4 years using this method.
That's the payback period. Quick and easy to calculate when flows are uniform.
But what if those cash flows aren't uniform? What if they bounce around from year to year? You can't use that simple division then, can you?
No, you can't. In that much more common scenario where cash flows vary significantly year to year, we have to use a slightly different cumulative approach.
Cumulative approach, how does that work?
It's pretty intuitive. You simply keep track of the cash flows year by year, adding them up cumulatively until that running cumulative total equals or exceeds the initial net investment amount. Then you figure out exactly when that crossover point occurred.
Okay, let's look at the Radon Technologies example for this. Their initial machine cost is $200,000.
$200K initial investment.
And their expected net after-tax cash flows are not uniform, they expect.
$90,000.
$80,000.
$75,000, and so on.
Okay, varying flows. Let's track the cumulative amount.
All right. After year one, the cash flow is $90,000. So the cumulative cash flow is just $90,000. Have we paid back the $200K yet?
No, 90K is less than 200K. Keep going.
Okay. In year two, they generate another $80,000. So the cumulative total at the end of year two is a $90,000 from year one plus the $80,000 from year two.
$90,000 plus $80,000 equals $170,000 cumulative after 2 full years. Still haven't reached the $200K initial cost.
Right, still short. Now in year three, they expect to get $75,000. If we add that full amount, we'd definitely be over $200K. So the payback happens sometime during year three.
Correct. The payback point is between the end of year 2 and the end of year 3. We need to figure out exactly how far into year 3 we need to go.
How we do that?
First, figure out how much more cash we still needed at the start of year 3. We needed $200,000 total, and we had already recovered $170,000 by the end of year 2.
So $200,000 minus $170,000, we still needed an additional $30,000 from year three's cash flow.
Exactly. We needed $30,000 more. Now, how much cash flow is expected during year 3?
Year three is expected to generate $75,000 total.
Okay. So, assuming the cash flow occurs evenly throughout year 3, we need to figure out what fraction of year 3's cash flow corresponds to that needed $30,000. We divide the amount still needed, $30,000, by year 3's total cash flow, $75,000.
$30,000 divided by $75,000, calculator says 0.40.
Right, 0.40. This means we need 0.40 or 40% of year 3's cash flow to reach the exact payback point.
So the total payback period for Radon Technologies is the 2 full years we already passed, plus that 0.40 fraction of year 3.
Exactly. The payback period is 2.4 years. This cumulative method lets us pinpoint the payback time precisely, even when the cash flows are uneven.
That's a neat way to handle non-uniform flows. Now, payback seems really simple and focuses on that quick return. What are its main pros and cons overall?
The payback method, despite its, compelling simplicity, presents a very distinct set of advantages and limitations that you really need to weigh.
Okay, advantages first.
Its key advantages are pretty undeniable. First, as we've seen, it's incredibly easy to use and understand. That makes it highly accessible even for managers who might not have a deep finance background.
So, easy communication. What else?
And second, as we discussed, it places a very strong emphasis on liquidity. It directs management's focus squarely onto how quickly that initial capital investment can be recovered.
Which is important for risk and cash flow management.
Absolutely. That's a paramount consideration, especially for companies maybe operating in very volatile or rapidly changing industries, or perhaps for smaller companies with limited access to external capital. In those situations, getting your principal back faster significantly reduces financial exposure and perceived risk.
Okay, ease of use and focus on liquidity are the big pluses. What about the limitations? These sound significant.
They are significant, and they must not be overlooked if you're relying solely on payback. The biggest, most fundamental limitation is that the simple payback method completely ignores the time value of money.
Ah, back to that core concept. Payback doesn't discount.
Nope. A dollar received in year 1 is treated as having the exact same value and weight as a dollar received in year 5, which, as we established firmly with NPV, is simply not economically accurate. It violates a core principle of finance.
Okay, ignores time value of money. That's a big one. What else?
Furthermore, another major drawback is that it completely ignores any cash flows that happen after the initial investment is recovered.
So once it hits payback, it stops looking.
Essentially, yes. It tells you how long it takes to get your money back, but it tells you nothing about the total profitability of the project over its entire economic life beyond that point.
So a project could pay back quickly but then die, while another pays back slower but generates huge profits for years after. Payback wouldn't show that difference.
Precisely. Payback would favor the first project, even if the second one is vastly more profitable overall. This neglect of post-payback cash flows means it can be fundamentally misleading when you're trying to assess the overall economic value or true long-term profitability of an investment. It also, by extension, ignores the potential impact of reinvesting those cash flows generated early in the project's life.
Wow. Okay, so while it's great for a quick look at liquidity and risk, it can be seriously misleading about overall value.
That's the trade-off. It's a useful initial screen or supplementary measure, perhaps, but it's generally considered insufficient as the sole basis for making major capital investment decisions due to these significant flaws.
That makes perfect sense. And that leads directly into the discounted payback method, doesn't it? It sounds like it tries to fix at least one of those big problems.
It does. The discounted payback method acts as a direct response to that primary limitation of the traditional payback period, the fact that it ignores the time value of money.
So discounted payback does consider the time value of money.
Yes, that's its key feature. It calculates the payback period using discounted cash flows instead of raw, undiscounted cash flows.
How does that work?
You first discount each year's expected after-tax cash flow back to its present value using the company's appropriate discount rate, like the WACC or hurdle rate.
Yeah.
Then you perform the same cumulative calculation we just did with Radon Technologies, but using these present values of the cash flows until the cumulative present value equals the initial investment.
Okay, so it tells you how long it takes for the present value of the inflows to recover the initial cost.
Exactly. Sometimes also referred to as the break-even time method, or BET. Its objective is essentially to evaluate how quickly new ideas or investments can be converted into profitable ideas, profitability being measured in present value terms.
And it still keeps that focus on speed of recovery.
Yes, it retains that focus on liquidity and how fast you recoup the investment. But it adds that vital layer of financial realism by factoring in the company's cost of capital through discounting. You often see this method used, for instance, in rapidly changing high-tech industries. Companies there want to recoup their investment quickly in present value terms, not just because of general risk, but specifically before their products or technologies potentially become obsolete in a fast-moving market.
So what are the advantages and limitations of this discounted version?
Well, the advantages and limitations are largely similar to the regular payback method, but with that crucial difference. It does incorporate the time value of money, addressing the biggest flaw of the simple payback.
So it's better than simple payback.
It is definitely considered theoretically superior to simple payback. However, even with this significant enhancement, it still largely focuses on how quickly the initial investment is recouped in PV terms. It still typically ignores cash flows occurring after the discounted payback period is reached.
So it still doesn't give the full picture of total profitability.
Correct. It doesn't provide that comprehensive picture of the overall profitability and total value generated by the entire project beyond that break-even point. So while it's a definite step up from simple payback, it's still generally viewed as inferior to NPV for assessing the total economic contribution of an investment. It's a better liquidity measure, but not the best overall value measure.
Okay, shifting gears now as we head towards the end, let's touch on a couple of more advanced, yet I think incredibly practical, concepts that often complement these core capital budgeting tools. First up is something called economic value added, which is often trademarked and simply called EVA.
EVA. Okay, economic value added. What is it measuring?
EVA is a really powerful performance measure, often used both for evaluating divisions or entire companies, but the concept can apply to projects too. It aims to quantify the actual economic profit generated. Specifically, it measures the excess of income after taxes, but calculated before financing costs like interest, usually called net operating profit after taxes, or NOPAT.
Okay, NOPAT, operating profit after tax. Earned over and above the company's total overall cost of capital for the investment used to generate that profit. And that cost of capital is usually represented by the WACC applied to the amount of capital invested.
So it's comparing the operating profit earned to the cost of all the money tied up to earn it.
Exactly.
Right.
That's the key idea behind EVA, and it's truly insightful. It forces you to ensure that profitability isn't just measured against, say, accounting rules or zero, but specifically in comparison to the cost of all the capital employed in the business, covering both debt and equity investors' required returns.
So it's a measure of true economic profit, not just accounting profit.
Precisely. It's asking, are we genuinely creating value beyond just covering the financial obligations we have to all our capital providers? It gets closer to answering, are we earning more than the opportunity cost of the capital we're tying up in this operation or project?
That sounds like a very useful metric. How is it calculated? What's the formula?
The basic formula for EVA is actually quite elegant. Economic value added equals net operating profit after taxes, NOPAT, minus the required return.
NOPAT minus required return. And how is that required return calculated?
That required return is simply calculated as the total dollar amount of investment, the capital employed, multiplied by the weighted average cost of capital, WACC, expressed as a percentage.
So EVA equals NOPAT, investment x WACC.
That's the core formula. And the interpretation is beautifully clear and intuitive.
How so?
A positive EVA indicates positive economic profit. It shows strong performance and signals that the company or project is effectively adding shareholder value. It's earning more than its total cost of capital.
And negative EVA.
A negative EVA, conversely, means there's an economic loss relative to the cost of capital. It indicates poor performance in economic terms, even if accounting profit might be positive. It suggests the entity is destroying shareholder value because it's not earning enough to cover the opportunity cost of the capital employed.
Okay, that's clear. Positive EVA good, negative EVA bad. Now, you mentioned it's sometimes complex. Are there adjustments involved in calculating NOPAT or investment for EVA?
Yes, in practice, calculating EVA accurately often involves some quite intricate component issues and specific adjustments that go beyond standard accounting figures. The goal is to get a truer picture of economic reality.
Like what kind of adjustments?
For instance, on the investment side, companies using EDA might capitalize certain expenditures like research and development, R&D costs, treating them as long-term investments that build value rather than expensing them immediately as traditional accounting often requires. They might also revalue certain balance sheet accounts like property, plant, and equipment to their estimated current market cost rather than using historical cost, less depreciation.
Trying to get the true economic value of capital tied up.
Exactly. And similarly, for income determination, the NOPAT figure used in EVA might be adjusted to eliminate the effects of certain non-cash items or non-operating transactions that might distort the picture of core operational performance. The aim is often to create something closer to a cash-basis income statement that more accurately reflects the sustainable, operational cash generation engine of the business.
So these adjustments are trying to make EVA a more precise and truer measure of genuine economic profit and value creation, stripping away accounting conventions that might obscure reality.
That's the intention. It's really about trying to get to the true underlying economic performance.
Okay, let's run through a quick example to make EVA concrete. Let's use the Instafab manufacturing example.
Instafab.
Instafab has a significant investment in one of its regional plants. The total capital invested in that plant after making all those EVA-specific adjustments, like capitalizing R&D, revaluing assets, comes out to $300,000.
Investment equals $300,000.
The company's overall cost of capital, its WACC, is determined to be 12%.
WACC, 12%.
And this particular division, the plant, produces a net operating profit, after taxes, NOPAT, of $50,000, again, after making various careful adjustments to reflect core operating performance accurately.
NOPAT equals $50,000.
Right.
So to calculate EVA, what do we do first?
First, we need to determine the required return in dollar terms. That's the investment amount multiplied by the WACC percentage. So $300,000 investment times 12% WACC.
$300,000 times 0.12 equals $36,000. This $36,000 represents the minimum dollar return Instafab needed to generate from that plant, just to cover the cost, the opportunity cost, of all the capital employed there.
$36,000 is the hurdle in dollar terms. Now we apply the core EVA formula.
Exactly. EVA equals NOPAT minus required return.
So $50,000, their actual NOPAT, minus $36,000, the required return, equals $14,000.
$14,000.
So what does this all mean for Instafab? Is that good?
Yes. That positive EVA of $14,000 is a very powerful indicator. It tells us that Instafab's plant has indeed added to shareholder value during the period. It demonstrates not just accounting profit, perhaps, but truly strong economic performance, generating returns above and beyond the full cost of its capital. It's a clear, quantifiable sign of wealth creation from that division.
EVA seems like a really insightful way to look beyond just standard accounting profit. Okay, one last concept before we wrap up. Using probability and expected value in these decisions, how does that fit in?
Right. Finally, let's briefly touch upon how sophisticated financial decisions, especially in capital budgeting where we're forecasting the future, try to formally incorporate the inherent uncertainty of that future. They often do this using the concepts of probability and expected value.
Probability first. What is it, simply?
Probability is really just a quantifiable chance or likelihood that a particular event or outcome will occur. It's usually expressed as a percentage, ranging logically from 0%, meaning absolutely no chance it'll happen, up to 100%, meaning it's an absolute certainty.
Like flipping a coin.
Exactly. The probability of getting heads is 50%. Or, in a more practical business context, a sales team might estimate that the probability of securing a specific large customer contract is, say, 70% based on their past experience in current negotiations. This foundational concept allows us to assign numerical likelihoods to different potential future outcomes, giving us a much clearer, more structured picture of the range of future possibilities, rather than just guessing.
All right, so probability assigns likelihoods. How does expected value use that?
Expected value builds directly on probability. It's a critical tool for decision-making under uncertainty. Expected value is formally defined as the weighted average of all possible outcomes, where each outcome is weighted by its assigned probability of occurring.
A weighted average based on likelihood. Can you give an example?
Sure. Let's use that car manufacturer example again. Imagine they're trying to predict next quarter's sales for a particular model. Based on market analysis, they might estimate there's 20% probability they'll sell 5,000 cars. Maybe an optimistic scenario if a competitor falters, and an 80% probability they'll sell only 4,000 cars. A more base case or likely scenario.
Okay, 20% chance of 5K, 80% chance of 4K.
Right. The expected value of cars sold would then be calculated as 80% probability times 4,000 cars outcome, plus 20% probability times 5,000 cars outcome.
So 0.80 by 4,000 plus 0.20 by 5,000.
That's 3,200 cars plus 1,000 cars, which totals an expected value of 4,200 cars.
4,200 cars. Now, that's not necessarily the number they will sell, right? They'll sell either 4K or 5K according to their estimates.
Exactly. 4,200 isn't one of the possible outcomes, but it represents the statistically most probable average outcome if this situation were to repeat many times. It's the long-run average expectation weighted by probabilities.
So how does this connect back to capital budgeting?
If we connect this to the bigger picture, these concepts assigning probabilities to different potential cash flow scenarios, maybe based on economic conditions, and then calculating the expected value of those cash flows for each year are absolutely fundamental. They allow for much more rigorous assessing and managing of risk and for making more informed decisions under uncertainty and sophisticated financial modeling. Instead of just picking one single number for future sales or costs, you can model a range of possibilities.
So it allows companies to move beyond mere single-point guesswork.
Precisely. It enables them to make much more educated, robust, and risk-adjusted projections about those crucial future cash flows, even when the future is inherently unpredictable. These tools help quantify the unknown to some extent and guide more strategic, probability-weighted choices. They add a layer of sophistication to the forecasting that underpins all these capital budgeting methods. #outro.
Wow. We have truly covered a remarkable amount of ground today. That was fantastic. And for everyone listening, you've just taken a really comprehensive deep dive into the very core, the nuts and bolts of how companies make some of their most pivotal, often multi-million or even billion-dollar investment decisions.
We really went through the key frameworks.
We absolutely did. We started right at the foundation, didn't we? Really dissecting cash flows, understanding those crucial direct and indirect effects like the tax shield, and tracing their journey throughout a project's entire life cycle, from inception to disposal.
Getting those cash flows right is paramount.
Then we moved squarely onto the net present value method, NPV. Clearly the undeniable gold standard, and we saw exactly why its relentless focus on adding absolute dollar value to the firm, its flexibility.
The king of capital budgeting, really.
We saw how the profitability index, PI, becomes such an indispensable tool for that real-world problem of capital rationing, guiding companies to make the smartest choices when resources are scarce.
Maximizing bang for the limited buck.
And we even tackled those often complex lease versus buy decisions, expertly breaking them down into those two separate manageable decisions, the investment decision and the financing decision.
Separating operational value from financing cost. Key insight there.
And we wrapped up by exploring other key methods too, like the internal rate of return, IRR understanding its focus on percentage rates, but also its really important inherent limitations. And the payback period, seeing how it prioritizes liquidity and a quick return of capital, even acknowledging its more financially robust discounted variant.
The key offers a different lens.
Exactly. Each and every one of these models provides a unique, often invaluable lens for evaluating these complex capital investments. It ensures that companies can scrutinize potential projects from pretty much every conceivable financial angle, hopefully making decisions that are robust and stand the test of time.
It's about making informed choices with significant long-term consequences. And hopefully this raises an important question for you, the listener. How does understanding these powerful models actually help you?
Yeah, beyond just understanding business news.
Right. It's not just about decoding complex corporate finance reports or business news headlines, although it certainly helps with that. It's really about sharpening your own strategic thinking when it comes to any kind of long-term investment, whether that's for a company you might work for or even applying these principles conceptually in your personal financial life.
Thinking about opportunity costs, time value, risk.
Exactly. Knowing when it's crucial to look for a strong, positive NPV, or understanding why a company might, in certain very specific contexts, prioritize a quick payback for a particularly risky venture that genuinely elevates your financial intuition and your own decision-making prowess.
So as you listening reflect on this deep dive we've taken, what really stands out to you about how these diverse models try to strike that delicate balance between speed of return, managing risk, and achieving that ultimate goal of long-term value creation?
It's a fascinating balancing act. And maybe for a final provocative thought for you to mull over, something to think about after we finish, especially considering our rapidly evolving world.
Okay.
In an era of seemingly accelerating technological obsolescence, constant disruption, and unprecedented change,
Right.
how might companies need to fundamentally alter their capital budgeting priorities in the future?
Good question.
Specifically, think about this. How might the increasing pace of asset devaluation or maybe shorter product lifespans change the way businesses weigh the trade-offs? Will they start prioritizing the immediate speed of payback, maybe using discounted payback more heavily, even if it means sacrificing some potential long-term value? Or will the sophisticated tools like NPV or maybe EVA, which focus on that total long-term value creation, become even more critical to ensure investments are truly sustainable and wealth-enhancing despite the rapid changes?
That's a really interesting tension, speed versus long-term value in a fast-changing world.
It's a question that could genuinely redefine investment strategy for businesses and perhaps even for individuals in the decades to come. Something to definitely keep thinking about.